Welcome back to Pensioners Corner. If you've got a savings account here in the UK, you're going to want to pay close attention to today's video, because HMRC has recently given new clarification on an important rule around savings tax. This rule affects how interest from your savings is treated, and it's something every saver, whether you've just started putting money aside or you've been saving for years, needs to know about. This isn't complicated jargon. It's about understanding how the £10,000 savings threshold works, what it means for your interest earnings, and how you should report them. So, let's walk through it step by step in plain English, so you can feel confident about what applies to you. Before we go any further, if you find clear financial explanations useful, don't forget to subscribe to Pensioners Corner. Here, we cover practical updates on pensions, savings, and everyday financial matters that impact people across the UK. Now, let's get started. Not too long ago, a question was raised to HMRC on social media. The question was simple but important: what exactly happens when someone earns interest from their savings? Do you need to contact HMRC yourself and declare it, or is it something the system sorts automatically in your tax code? This question hit a nerve because many savers aren't sure how the process works, especially now that interest rates have shifted in recent years. HMRC responded with a detailed explanation, and that's what we're breaking down today. Here's the first key point: if the interest you earn from savings in a single tax year is more than £10,000, you must report it to HMRC by filing a self-assessment tax return. That means completing the same type of form that people who are self-employed use, even if you're employed and your tax is normally handled through pay. On the other hand, if your total interest from savings is less than £10,000 in a tax year, you usually don't need to file a full tax return. Instead, you can simply make sure it's reported through the pay system, and HMRC can adjust your tax code if necessary. So, the £10,000 number is an important dividing line. Cross it, and self-assessment is required. Stay below it, and pay usually covers it. But let's dig deeper, because there are layers of allowances and reliefs that can make a big difference to whether you owe tax on your savings at all. Let's start with the personal allowance. This is the amount of income you can earn before paying any income tax. At the moment, it's £12,570 per year. If you don't use up all of that allowance through your job, pension, or other income, the unused portion can be applied to savings interest. This means that for people with modest incomes such as part-time workers, retirees with smaller pensions, or students, some or even all of their savings interest could be completely tax-free. But that's just one part of the picture. There's also something called the starting rate for savings. This is an additional allowance that can give you up to £5,000 of savings interest tax-free. However, it only applies if your other income is relatively low. The way it works is that for every £1 you earn above your personal allowance, your starting rate allowance reduces by £1. Once your income goes above £17,570, you no longer qualify for this starting rate. In other words, the starting savings rate is mainly aimed at people on lower incomes, allowing them to keep more of their savings interest without being taxed on it. Now, even if you don't qualify for the starting rate, there's also the Personal Savings Allowance, or PSA, which applies much more broadly. How much you get depends on your income tax band. If you're a basic rate taxpayer, earning up to £50,270, you can earn up to £1,000 in savings interest each year completely tax-free. If you're a higher rate taxpayer, with income between £50,270 and £125,140, your allowance is £500. And if you're an additional rate taxpayer, earning above that, you don't get a personal savings allowance at all. So, where you fall in the tax bands makes a big difference. For many savers, especially those in the basic rate band, a large portion of their savings interest may already be shielded from tax thanks to this allowance. Now, the next question many people ask is, how does HMRC even know how much interest you've earned? The answer is that most banks and financial institutions provide this information at the end of the tax year. You'll usually receive either a tax summary or a certificate of interest, showing exactly how much you've made. HMRC uses this data, and if you're under the £10,000 threshold, they may automatically adjust your tax code. That said, It's very important to check that the figures are correct. While HMRC does receive reports from banks, mistakes or delays can happen, and ultimately it's your responsibility to make sure the information is accurate. If you want to avoid paying tax on interest altogether, one of the most effective tools available is the Individual Savings Account, or ISA. Money held in an ISA, whether a cash ISA, a stocks and shares ISA, or an innovative finance ISA, grows tax-free. That means any interest or investment returns inside your ISA are completely shielded from income tax, no matter how much you earn elsewhere. For the current tax year, the ISA allowance is £20,000. You can spread this allowance across different types of ISAs if you want to. For example, you could put some into a cash ISA for security, some into a stocks and shares ISA for growth potential, and some into an innovative finance ISA if you're comfortable with that type of investment. If you're someone who regularly earns interest above the tax-free thresholds, making use of your ISA allowance can be a very practical way to reduce or even eliminate tax on savings. Now let's connect all of this with the wider financial environment. In August, the Bank of England reduced the base interest rate from 4.25% to 4%. This kind of change directly affects how much banks are willing to pay on savings accounts. Typically, when the base rate goes down, banks lower the interest rates they offer on savings. That means your returns can shrink, even if you're saving the same amount. The next base rate decision is scheduled for September 18. Nobody can say for sure what will happen, whether rates will drop again, hold steady, or eventually rise. What we do know is that any change in the base rate tends to ripple through to savings accounts, affecting how much interest people earn and, by extension, how much tax they might owe. This is why it's so important to not only track the amount of interest you're earning but also stay aware of how the tax rules apply. Even relatively small amounts of interest across several accounts can add up over a year, and you don't want to overlook reporting obligations. To quickly recap the essentials. If your savings interest goes over £10,000 in a tax year, you must file a self-assessment tax return. If it's under £10,000, it can usually be reported through pay, but you should double-check your tax code. The personal allowance, the starting savings rate, and the personal savings allowance can all help reduce or eliminate the amount of tax you owe on savings interest, depending on your overall income. ISAs provide a completely tax-free shelter for savings and investments, up to the annual allowance. Staying on top of these details isn't just about avoiding mistakes. It's also about making sure you're not paying more tax than necessary. By using allowances effectively and considering ISAs, you can make your savings work harder for you. One last point, always keep an eye out for the documents your bank sends after the end of the tax year. Those certificates of interest or annual summaries are key pieces of information for ensuring your tax records are correct. Don't just assume HMRC has everything covered, take the time to check. If at any point you're uncertain about your specific situation, the safest thing to do is either speak with a qualified financial advisor or check HMRC's official website. Their guidance is regularly updated, and it's the best way to make sure you're relying on accurate, official information. And that brings us to the end of today's video here on Pensioners Corner. We've taken a detailed look at HMRC's £10,000 savings interest rule, and hopefully, it's now a lot clearer how it all fits together. If you found this explanation useful, please hit the like button, it really helps support the channel. Share this video with friends or family who have savings accounts, because this information could be just as important for them as it is for you. And of course, don't forget to subscribe for more practical guides, financial updates, and tips to help you make the most of your money. Thanks for watching, and as always, stay informed, stay careful with your savings, and take steady steps toward your financial well-being.